Right now, as we speak, SoFi Technologies Inc., ticker symbol SOFI, is trading live at exactly $27.42. We are seeing a slight intraday push, up roughly 2.5 cents or nearly 0.1% in this session. It is hovering in a tight consolidation range, bouncing between 26.82 and 27.47, trying to decide if it wants to break out past that psychological resistance or fade back into the volume shelf. But if you are just looking at that green number and thinking this is a quiet day for a standard bank stock, you are missing the tectonic shift happening right underneath the order book. The expectation on the street, what the headlines and the casual retail traders will tell you, is that SoFi has had its run. They will say that after the massive 75% rally over the last year, the valuation is stretched, the price-to-earnings multiple of nearly 50 is too rich, and that this is just another neobank susceptible to the next credit cycle downturn. That is the expectation, a high-beta fintech stock that has flown too close to the sun. But the reality? The reality is substantially different and far more aggressive. What we are actually witnessing in this price action isn't exhaustion, it is accumulation. We are seeing a fundamental repricing of SoFi, not as a bank, but as a technology infrastructure company that just happens to have a banking license attached to it. The market is waking up to the fact that while everyone was arguing about student loan forgiveness, SoFi was quietly building the AWS of fintech through Galileo and Technisys, and that bet is finally paying off in the Q3 2025 numbers we just saw. This isn't a story about interest rates anymore, it is a story about diversified compound growth that the legacy players like Fidelity or Schwab Intelligent Portfolios simply cannot replicate with their legacy tech stacks. Let's look at the tape. The stock opened today at $25.83, and immediately we saw a flush of liquidity. That dip to $26.82 wasn't retail panic, that was institutional reallocation. We know that major players like Vanguard and BlackRock have been increasing their positions significantly in late 2024 and throughout 2025. When you see a stock gap down slightly and then immediately get bought up to reclaim the $27 handle, that tells you there is a buy wall sitting underneath. The volume today is already ticking past 60 million shares, which is healthy but not manic. It suggests that the weak hands who bought for a quick flip are out and the strong hands are building long-term positions. The price action is respecting the technicals beautifully, finding support right where the 50-day moving average would theoretically sit if you look at the charts. Now, why is this happening? You have to look at the earnings print we just got for Q3 2025. The expectation was 9 cents a share. SoFi delivered 11 cents. That is a 22% beat. But the headline number is the least interesting part. The real story is the revenue composition. For the first time, we are seeing the financial services segment, that is the checking, savings, SoFi Invest, and credit cards, contributing massively to the bottom line. This segment used to be a cash incinerator. It was the loss leader to get people in the door. Now, it is a profit engine. Net revenue hit a record $962 million. That is nearly $1 billion in a single quarter. And remember, the expectation was that as interest rates stabilized in 2025, their lending margins would compress. The reality was the opposite. They expanded their net interest margin because their cost of funding is so incredibly low compared to a Robinhood or a SoFi competitor that doesn't have a bank charter. When you look at online investing and the broad landscape of investing sites, there's a war for deposits. Interactive Brokers is fighting for cash. Fidelity Investments is fighting for cash. But SoFi has created a mousetrap that is simply better. They are offering high-yield savings that attract the deposits and then, and this is the genius part, they're using those deposits to fund their loans. They don't have to go to the capital markets and borrow money at 5 or 6% to lend it out. They're using their members' money, paying them a generous 4-ish% and lending it out at 12, 15, or 20%. The spread is massive. This is the bank charter advantage that the bears consistently underestimated. They thought the charter was just a vanity plate. In reality, it was the moat. Let's take a step back and talk about the Technisys and Galileo aspect, because this is where the Tesla stock comparison actually makes sense. People buy Tesla stock not just for the cars, but for the FSD and the energy business. People should be looking at SoFi for the technology platform. Galileo is the engine that powers Robinhood stock trading accounts, Chime, and dozens of other fintechs. Every time a user on a different platform swipes a card or creates an account, SoFi gets paid a fraction of a cent. It is a toll road on the entire digitization of finance. And recently, with the integration of Technisys, they can now offer a full core banking solution to legacy banks. Think about a regional bank that is running on code written in the 1980s. They can't offer self-investing tools or slick mobile apps. They are bleeding customers to SoFi and Robinhood. Their only choice is to upgrade. Who do they call? They call SoFi to license the tech. This creates a B2B revenue stream that is recurring, high margin, and completely independent of whether the economy is in a recession or a boom. The market is just now starting to price this in, which is why we're seeing this resilience at the $27 level. But I want to challenge you to think about the risk here, because I promised we would look at the tension between expectation and reality. The expectation is that SoFi is now a safe play because it is profitable. The reality is that they are still aggressively growing their unsecured personal loan book. In a severe recession, if unemployment spikes, personal loans are the first thing people stop paying. They will pay their mortgage, they will pay their car note, but they might default on that $20,000 consolidation loan. SoFi argues that their borrowers have high FICO scores and high incomes, the so-called Henrys, high earners not rich yet. And so far, the data supports them. Their default rates have actually trended down in Q3 2025, while the broader industry saw them tick up. That divergence is the alpha. It suggests their underwriting models, which use machine learning and alternative data, much like Upstart, but with better internal data, are superior to the traditional FICO-based models used by a Fidelity brokerage or a traditional bank. Speaking of Fidelity, we need to talk about the competitive landscape. If you are looking for investment help, you have the old guard like Fidelity Wealth Management and Fidelity IRAs. They're massive, trusted, and have trillions in assets. Then you have the disruptors like Robinhood App and Robinhood Crypto, which captured the Gen Z trader. SoFi sits perfectly in the middle. They offer the trust and breadth of a Fidelity with Fidelity mutual funds and Fidelity ETFs equivalents, but with the user experience of a Robinhood. This super app strategy is incredibly difficult to execute. PayPal tried and failed. Block, Square, is struggling to connect the dots. SoFi has actually done it. You can refinance your student loan, buy NVIDIA stock, check your credit score, and get a mortgage in one app. And because they own the vertical stack, they can cross-sell like crazy. The data shows that a member who joins for a loan and then opens a SoFi Invest account becomes exponentially more valuable and less likely to leave. This brings down their customer acquisition cost, CAC, drastically. While interactive brokers might spend hundreds to acquire a heavy trader, SoFi acquires a member for a loan, makes money on the loan, and then gets the investment account for free. I want to pause here for a second and get a pulse check from you guys. Comment below how many shares of SoFi you currently hold, and more importantly, what is your average cost basis? Are you one of the OGs who held through the SPAC days, Or did you load up in the single digits back in 2023? I'm genuinely curious to see where the sentiment is at. Now, let's look at the investment side of the business specifically. SoFi Invest has been rolling out features that rival the big boys. They added options trading, they have SoFi Robo-Advisor, which competes directly with Schwab Intelligent Portfolios, and SoFi Active Investing for the pickers. They recently launched a proprietary all-in-one ETF that automatically rebalances, similar to Fidelity ETFs, but with lower fees for members. This is critical because it creates sticky assets. It's easy to move cash. It's hard to move a portfolio. By getting members to use SoFi Investing, they are locking them into the ecosystem for decades. And let's not forget the fractional shares aspect. Robinhood fractional shares popularized this, but SoFi made it a core part of their Get Your Money Right branding. It appeals to that younger demographic that might not have enough to buy a full share of Tesla stock or Apple stock, but wants a